Big Banks, Household Credit Access, and Intergenerational Economic Mobility. Erik J. Mayer, Cox School of Business, Southern Methodist University, September 21, 2020. For helpful comments I thank Alex Butler, Charles Calamiris, Alan Crane, Gustavo Grulin, Aaron Pancost, James Weston, and seminar participants at the University of Michigan, Rice University, Southern Methodist University, Vanderbilt University, University of Houston, University of Arizona, and American University. I also thank conference participants at the Lone Star Finance Conference, the Banking and Finance Workshop at the Federal Reserve Bank of Dallas, the Financial Management Association meeting, and the Columbia Banking Policy Institute Research Conference. Any remaining errors are my own. Big Banks, Household Credit Access, and Intergenerational Economic Mobility. Abstract. Consolidation in the United States banking industry has led to larger banks. I find that low-income households face reduced access to credit when local banks are large. This result appears to stem from large banks' comparative disadvantage using soft information, which is particularly important for lending to low-income households. In contrast, the size of local banks has little or no effect on high-income households' access to credit. Moreover, intergenerational economic mobility is lower in areas where banks are large, consistent with low-income parents' additional credit constraints limiting their investment in their children's human capital. The United States banking industry has experienced tremendous consolidation since states began removing barriers to bank expansion in the 1970s, leading to much larger banks. From the average U.S. household's perspective, the median-sized bank within 10 miles of their home is over 7 times larger today than it was in 1995. In this paper I test whether the size of banks affects households' access to credit, and through this channel, intergenerational economic mobility. It is unclear whether we should expect larger banks to lead to more or less credit access for households. Stein 2002 predicts small banks will have a comparative advantage using soft information to reduce information asymmetries, which should increase credit access. Stiglitz and Weiss, 1981. On the other hand, large banks benefit from economies of scale, and from diversification that reduces the cost of delegated monitoring. Diamond, 1984, and allows banks to lend out a higher proportion of their capital, for example. Demsetz and Strahan, 1997. If these benefits increase the supply of loanable funds enough to outweigh any effects of reduced soft information production, we might expect larger banks to improve households' access to credit, especially in cases where soft information is less important. I find that borrowers of low economic status, that is, low income, subprime credit score, and/or limited credit history, experience lower credit approval rates when local banks are large. In contrast, the size of banks has little or no effect on borrowers of high economic status. The evidence suggests that this asymmetric effect stems from the increased importance of soft information for lending to low-income households. These findings naturally raise the question of whether consolidation in the banking industry contributes to economic inequality. Equality of opportunity, the principle that an individual's success depends primarily on their abilities and work ethic rather than family circumstance, is characterized by intergenerational economic mobility. High mobility levels indicate that children from low-income families have the opportunity to move up in the income distribution as adults. In theoretical models, credit access plays an important role in fostering mobility by allowing low-income households to invest in their children's human capital, for example. Becker and Tomes, 1979, 1986. Therefore, I test the hypothesis that having large banks reduces intergenerational mobility due to the additional credit constraints low-income households face. I find evidence in support of this hypothesis using newly available data on mobility from Chetty et al., 2014. This finding constitutes the first evidence of a link between the characteristics of financial institutions and intergenerational mobility. The first set of empirical tests examine household credit access using a nationally representative sample of credit bureau records that provide individuals' age, census tract, credit score, debt by category, mortgage, auto, etc., credit application inquiries, and other financial variables. The baseline OLS regressions show that large bank market share, the fraction of bank branches within 10 miles of a borrower owned by banks with assets over $1 billion, has a negative effect on credit approval rates for borrowers of low economic status. These regressions control for borrower credit scores and individual, census-tract, and county-level characteristics, as well as local banking competition and state-by-year fixed effects. Despite the rich set of explanatory variables, this paper must address the challenges to identification that may arise from borrowers' credit applications not being randomly assigned to banks. The potential selection comes in two layers. First, borrowers can choose which banks to try when applying for credit. Importantly, we should expect this source of selection to work against finding that the composition of local banks affects credit access, because borrowers likely end up applying for credit at the type of bank most willing to lend to them either knowingly, or through trial and error shopping. 1. The second layer of potential selection stems from the fact that the composition of local banks reflects large banks' location decisions. If large banks' location decisions are correlated with an unobservable component of borrower credit quality, it could generate an omitted variables problem. However, it is important to point out that if large banks systematically buy branches where they want to lend to local households, we should expect the resulting bias to work against the baseline OLS result that large banks reduce households' access to credit. To avoid an omitted variables bias, I employ an instrumental variables approach that isolates exogenous variation in large bank market share. I exploit differences in state policies that restrict the ability of out-of-state banks, for example, national banks, to enter local markets by building new branches or purchasing existing ones. I identify 36 state borders where one state has strong regulatory barriers to out-of-state bank branching, and the other state is open to entry. Unsurprisingly, branches in the state with barriers to out-of-state bank entry are owned by smaller banks. I select everyone in the credit bureau data living within 50 miles of these borders and use their location relative to the border to instrument for large bank market share. The differences in regulation make a person's position relative to the border an instrument for large bank market share even when comparing two people living in the same state. For example, a person living 11 miles towards the interior of the state with regulatory barriers and small banks will have a lower large bank market share than someone in the same state who lives near the border, because the neighboring state's banks are large. The identifying assumption this approach makes is that for two borrowers in the same state during the same year, controlling for credit scores and individual, census-tract, and county-level characteristics, their distance to the state border affects credit approval only through its effect on large bank market share. The results from these instrumental variables tests show that a standard deviation increase in large bank market share decreases subprime borrowers' credit approval rates by 3.8 percentage points compared to their mean approval rate of 53.0%, whereas the effect on prime borrowers' credit approval is positive but statistically insignificant. The estimated effect of large bank market share is larger in the instrumental variables regressions than their OLS counterparts, suggesting that any omitted variables bias indeed works against the OLS results. The second set of empirical tests use Home Mortgage Disclosure Act (HMDA) data on mortgage applications, where the lender's identity is directly reported. I test the hypothesis that low-income households have better access to mortgage credit at small banks, and that small banks have a comparative advantage using soft information. I find that small banks approve a higher percentage of mortgage applications, consistent with these banks collecting soft information to price risks and ration credit less. I also find that as the distance from the property to the lender's nearest branch increases, the mortgage approval rate decreases, especially when the borrower has a low income and/or the bank is small. Following the interpretation in the literature that borrower-lender distance affects credit provision through soft information production, for example, Peterson and Rajan 2002, DeYoung et al. 2008, Agarwal and Hauswald 2010, these cross-sectional results indicate that soft information is especially important when lending to low-income households, and that smaller banks incorporate more of this information into lending decisions. In addition, I find that conditional on loan characteristics, delinquency rates are similar for mortgages originated by large and small banks, despite small banks approving a higher percentage of loans. This finding suggests the higher approval rates at small banks reflect an advantage using soft information, rather than a tendency to originate bad loans. After establishing that low-income households face tighter credit constraints when local banks are large, I test the hypothesis that large banks reduce intergenerational mobility. I use newly available mobility statistics computed at the county level by Chetty et al. 2014, from the IRS tax returns of children born in the early 1980s and their parents. Controlling for a broad set of covariates outlined in Chetty et al. 2014, plus additional controls, I find that the share of bank branches in a county owned by large banks has a negative effect on mobility levels. To isolate plausibly exogenous variation in the size of local banks during the childhood of children in the Chetty et al. 2014 data, I use an instrumental variables approach that exploits the staggered removal of state regulations prohibiting interstate bank mergers. Prior to a state's decision to deregulate, out-of-state banks could not enter local markets. States removed these regulations from 1978 to 1997, and the number of years since the state deregulated serves as a powerful instrument for the fraction of branches owned by large banks. The instrumental variables results show that having larger banks leads to lower intergenerational mobility levels. Specifically, a standard deviation increase in the share of large bank branches in a county causes a 4.7 percentage point reduction in the probability that a child with parents in the bottom 40% of the income distribution ends up outside this bottom 40% as an adult, compared to a mean probability of 51.5%. This paper is related to studies showing small banks are important providers of credit to small businesses, consistent with an advantage lending based on soft information. 2. Although recent work suggests soft information matters when lending to households, for example, Agarwal et al. 2011 and Iyer et al. 2016, evidence on whether small banks play a special role in this setting is limited. 3. My paper contributes to this literature by providing loan-level evidence that small banks incorporate more soft information when lending to households, and by showing that low-income households are most affected by the size of local banks. This paper is also connected to studies on the effects of banking deregulation and consolidation. These studies typically examine deregulation's effect on economic growth, or on firms. 4. Recent work also finds mixed evidence on the net effect of banking deregulation and consolidation on households' access to bank accounts. Sellerer and Matre 2017, and Board 2017. In contrast, my paper is the first to examine the effects on the distribution of credit across households, and on economic mobility. My work is also closely related to papers examining the effect of credit constraints on intergenerational mobility. Several studies using household survey data find that constraints reduce mobility. Gaviria 2002, and Mazumder 2005. However, Black and Devereux 2011 review this literature and point out that it relies on small samples and struggles to address endogeneity issues that arise from using wealth as a proxy for credit constraints. I contribute to this literature by showing credit constraints reduce mobility using plausibly exogenous variation in low-income households' constraints based on banking deregulation and the size of local banks. This paper's findings also provide the first evidence of a link between the structure of the banking industry and intergenerational mobility. 1. Regulatory restrictions on bank expansion. Banks in the United States have faced restrictions on geographic expansion since the Constitution gave states the right to charter and regulate banks. See Krosner and Strahan 2014. Prior to the Civil War, this authority remained with the states, and few banks established branches either within their home state, intrastate branching, or across state lines, interstate branching. See Johnson and Rice 2008. The Mcfadden Act of 1927 formalized states' authority to regulate all bank branching activity within their borders. Prior to 1970, most states restricted intrastate branching. Then, throughout the 1970s and 1980s, states removed these restrictions and allowed the banks in their state to build branches and to convert subsidiaries and new acquisitions into branches. This intrastate banking deregulation started the process of banking consolidation that has led to larger banks. Figure 1 shows the continued consolidation from 1995 to 2015 from the average U.S. household's perspective by plotting the fraction of branches owned by small banks and the median size of banks who own branches within 10 miles of the household. The states also historically used their authority to limit banks' expansion across state borders by prohibiting cross-state ownership of banks, interstate banking, and bank branches, interstate branching. The process of removing barriers to interstate banking began in 1978, when Maine decided to allow out-of-state banking companies to acquire its banks, as long as the acquirer's home state reciprocated and gave banks in Maine the right to acquire banks in their state. Other states began to pass similar laws starting in 1982, and by 1993 every state except Hawaii allowed interstate banking. See Table 1 for the years that states deregulated. I use these staggered interstate deregulation events to isolate plausibly exogenous variation in the size of banks as of 1995 in order to study the effect of local bank size on intergenerational mobility. Although states opened their borders to bank acquisitions throughout the 1980s, only a few states allowed out-of-state banks to establish branches in their state prior to the passage of the Regal-Neal Interstate Banking and Branching Efficiency Act, IBBEA, in 1994. The IBBEA removed remaining federal barriers and allowed bank holding companies (BHCs) to engage in interstate banking and branching. However, the IBBEA also gave states the power to erect barriers to limit the entry of out-of-state banks. States were allowed to restrict out-of-state bank entry with 4 regulatory provisions. 1. The minimum age of the target institution in an interstate bank merger. 2. De novo interstate branching. 3. The acquisition of individual branches, and 4. A statewide deposit cap. I follow Rice and Strahan 2010, and construct an index describing states' policies toward out-of-state bank entry that ranges from 0 to 4. The index takes a value of 0 for states most open to out-of-state bank entry, and 4 for states that use all 4 possible regulatory barriers to make it more difficult for out-of-state banks to establish branches. Specifically, I add 1 to the index if the state sets the minimum age requirement for target banks in an interstate merger at 3 years or more, if the state prohibits out-of-state banks from building new branches within its borders, de novo branching, if the state prohibits the acquisition of individual bank branches, and if the state sets their statewide deposit cap for banks at less than 30%, the initial limit set by the IBBEA. I use state borders where states have large differences in interstate branching policies to study the effect of the size of banks on household credit access using credit bureau data from 2010 to 2015. The Dodd-Frank Act effectively eliminated states' ability to restrict de novo branching starting in July 2010. Therefore, I assign each state its value of the Branching Restriction Index based on the state laws as of the start of 2010. This method ensures that states that prevented de novo branching from 1994 to 2010 are classified as having been more difficult for out-of-state banks to enter than states that allowed de novo branching during this period. The reduced amount of de novo branching since the financial crisis also makes states' historical de novo policies important to account for. 2. Data and methods. 2.1. Data sources overview. I used identified Credit Bureau Records and Home Mortgage Disclosure Act (HMDA) data on mortgage applications in order to analyze approval rates on individuals' credit applications. To test whether large banks reduce intergenerational mobility by tightening low-income households' credit constraints, I use county-level statistics on mobility published by Chetty et al. 2014. These statistics are computed from Internal Revenue Service (IRS) tax returns. The main explanatory variables of interest in this paper are the characteristics of local banks, or of the specific bank receiving the credit application, when this is directly observable, that is, when using HMDA data. The locations of bank branches in terms of latitude and longitude are available from the Summary of Deposits data published by the Federal Deposit Insurance Corporation (FDIC). I match bank branches to the commercial banks who own them, and collect data on these banks' characteristics from the Reports of Condition and Income (call reports) published by the Federal Financial Institutions Examination Council (FFIEC). In order to control for a broad set of characteristics describing a location, this paper uses county-level and census tract-level data from the U.S. Census Bureau. I also use county-level data on unemployment rates and personal income from the Bureau of Labor Statistics (BLS) and the Bureau of Economic Analysis (BEA), respectively. The paper also uses additional county-level control variables collected from the National Center for Education Statistics (NCES), the George W. Bush Global Report Card, the Association of Religion Data Archives (ARDA), and the Federal Bureau of Investigation. I also use county-level statistics describing income inequality computed in Chetty et al. 2014 and the county-level measure of social capital computed in Rupasinga et al. 2006 as controls. 2.2. Credit Bureau Data. This paper uses a panel dataset of anonymized individual credit bureau records. The data are a 1% representative sample of all U.S. residents with a credit history and social security number. Any individual who has an open credit account from a lender reporting to the credit bureau's mortgage, auto loan, credit card, etc., or who previously had an account that closed within the last 7 years has a credit history. Additionally, even individuals who have never used credit, but have a public record bankruptcy, tax lien, court judgment, etc., in the last 7 to 10 years, depending on the record type, will have a credit bureau file. For reference, 12% of the observations in the sample are individuals with no current open lines of credit or past due debt. These observations come from individuals who had accounts in the previous 7 years and closed them, or whose credit bureau file exists because of a public record. The 1% sample of credit bureau data was constructed by selecting all individuals with social security numbers ending in an arbitrarily chosen final 2 digits, for example, all social security numbers ending in 10. The Social Security Administration sequentially assigns the last 4 digits of social security numbers to new applicants, regardless of geographical location. Hence, the sampling procedure produces a random sample of individuals. This sampling method produces a panel that tracks individuals over time, and allows individuals to enter and exit the sample at the same rate as the target population, ensuring that the sample remains representative of the target population over time. This sampling design closely follows that of the Federal Reserve Bank of New York Consumer Credit Panel, see Lee and van der Klauw, 2010, for a detailed description of the sampling design and credit bureau data. The dataset in this paper includes annual observations for approximately 2.3 million individuals per year. The observations are based on data extracted from the credit file on December 31 each year. The credit bureau data provide a complete credit history for each individual, including the individual's credit score, total debt, debt by category, mortgage, auto, credit card, etc., past due debt, new sources of credit opened, and hard credit inquiries. These credit inquiries occur when a borrower applies for credit, and the lender checks their credit report. The data also provide the individual's age and the census tract they live in. 2.3. Mortgage application data. The Home Mortgage Disclosure Act requires all banks with total assets above $44 million 2016 threshold, and at least one branch in a Metropolitan Statistical Area (MSA), to report detailed information on all mortgage applications they receive, and their credit approval decision. The HMDA data include loan size, whether the application is a joint application, the applicant's income, and the race and ethnicity of the applicants. The data also contain information on the purpose of the loan, home purchase, refinancing, or home improvement, and whether the loan would be secured by a first or second lien. The location of the real property the mortgage would be on is reported at the census tract level. In order to construct the sample of mortgage applications for this paper, I merge lenders in the HMDA data to banks in the call report data based on federal agency identifiers common to both databases, and based on names for the remaining unmatched banks as in Lautzkina and Strahan, 2009. I select all mortgage applications received by commercial banks that are required to report HMDA data. I then exclude applications that the lender did not make a decision on due to the application being incomplete or withdrawn. Next, I require the application to be for a conventional mortgage, excludes applications related to programs run by the Federal Housing Administration, Veterans Administration, Farm Service Agency, or Rural Housing Service. I limit the sample to first lien home purchase mortgage applications that are for loan amounts below the government-sponsored entity's securitization limits, excludes jumbo loans. Finally, I require the property the mortgage would be on to be located within an MSA, because this is where HMDA data are the most comprehensive. This process results in a sample of just over 4.7 million conventional mortgage applications between 2010 and 2015. 2.4. Intergenerational mobility data. I use county-level data on intergenerational mobility published by Chetty et al., 2014. The authors obtained access to records from the Social Security Administration and Internal Revenue Service, and were able to link children to their parents based on parents claiming their children as dependents on tax returns. The authors collect information on children born from 1980 to 1982 and their parents. Parental household income is measured as the average combined income of parents from 1996 to 2000, that is, when the child is 15 to 19 years old, and the children's income is measured at age 26, that is, 2006 to 2008. The author's sample includes 9.9 million children matched to their parents. Based on these administrative data, Chetty et al., 2014, construct county-level intergenerational mobility statistics. Specifically, the authors provide estimates of the slope coefficient from a regression of child income rank on parent income rank for the people in a given county. This parent-child income slope is the coefficient from a rank-rank regression of child income distribution centile on parent income distribution centile, using the national income distribution. The authors also report transition matrices that describe the probabilities a child ends up in each quintile of the income distribution, based on which quintile of the distribution their parents were in. The two measures of mobility I use are the parent-child income slope, and the probability that a child with parents in the bottom 40% of the income distribution moves out of this bottom 40% as an adult. I also examine the sensitivity of children's college attendance to their parents' income using data provided by Chetty et al., 2014. 3. The effect of large banks on household credit access. 3.1. Baseline Ols results. In this section I examine whether the size of local banks affects households' access to credit. To estimate the effect of having large local banks on households' credit access, I regress an individual's credit approval on large bank market share. Credit approval measures an individual's access to credit by taking a value of 1 during years the person successfully opens a new line of credit, and a value of 0 when the person applies for credit during the year but does not open any new credit lines. I exclude credit card applications and credit lines when constructing credit approval because credit card lending is dominated by a few national banks and is less likely to depend on local branches. Large bank market share is defined as the fraction of bank branches within 10 miles of the census tracked the individual lives in that are owned by banks with greater than $1 billion in assets 2010 dollars. In order to test whether large banks have a heterogeneous effect on borrowers of high versus low economic status, I interact large bank market share with indicators for the borrower having a low income, subprime credit score, or limited credit history. Low income indicates the borrower's estimated income from the credit bureau's proprietary model at the end of the prior year was below the median. This model is developed by the credit bureau based on a large sample of individuals' reported incomes on IRS tax returns and all of the individual attributes the credit bureau has on file, and it is re-verified annually. Subprime indicates the borrower's Vantage score at the end of the prior year was less than or equal to 660, the cutoff defined by the credit bureau as subprime. Approximately 43% of borrowers are subprime. Limited credit history indicates the borrower had below the median number of open credit lines at the end of the prior year, 2 or fewer. The regressions of credit approval on large bank market share also include individual characteristics as of the end of the prior year, census-tracked characteristics, county-level variables, and state-year fixed effects. Panel A of Table 1 presents summary statistics describing the outcome variables from the Credit Bureau data, as well as the individual and location-based control variables. The Credit Bureau dataset contains approximately 2.3 million annual observations per year from 2010 to 2015. Panel B of Table 1 summarizes how often individuals apply for various types of credit. To allow for nonlinearities in the regressions of credit approval on large bank market share, I control for several of the individual characteristics using fixed effects based on binned values. The bins are based on 10-point intervals for Vantage score, 5% ventals for estimated income, and on each unique value for number of credit lines and age. These fixed effects for Vantage score, estimated income, and number of credit lines eliminate the need to control for the direct effect of subprime, low income, and limited credit history when interacting these indicator variables with large bank market share, because the indicator is a direct linear combination of the fixed effects for the variable it is based on. The remaining individual characteristics control for the amount of total debt and delinquent debt the person has. The census tract variables describe the local population where the person lives, and proxy for non-financial personal characteristics. The county-level variables control for local economic conditions. Finally, the state year fixed effects are important because they control for differences in state policies that might affect credit supply, for example, bankruptcy exemptions, foreclosure laws, or debt collection laws. Table 2 presents the baseline Ols results. The regression in column 1 shows that a standard deviation increase in large bank market share leads to a 0.43 percentage point decrease in credit approval across all borrowers, compared to the mean credit approval of 68.4%. The regressions in columns 2 to 4 show that this result from column 1 is driven by a much larger reduction in credit access for individuals of low economic status, whereas borrowers of high economic status are relatively unaffected. For instance, column 3 shows that a standard deviation increase in large bank market share leads to a minus 0.11 percentage point decrease in credit approval for borrowers with prime credit scores, whereas it leads to a minus 0.80 percentage point decrease in credit approval for subprime borrowers whose mean credit approval is 53%. A similar pattern is seen in the results in columns 2 and 4 when low income and limited credit history are used to define borrowers of low economic status. Figure 2 shows the heterogeneity in the effect of large bank market share on borrowers of high versus low economic status by plotting residual credit approval against residual large bank market share for prime and subprime borrowers separately. The residual versions of the two variables are computed by regressing each variable on all of the control variables in the regressions in Table 2, except for large bank market share. These plots implement the Frisch-Waugh theorem to show visually how the unique variation in large bank market share, net of the other controls, predicts credit approval. The striking difference between the plots shows that having large local banks leads to a much larger reduction in credit access for subprime borrowers than prime borrowers. 3.2. Identification issues and Ols results for subsamples. At this point it is important to discuss potential reasons why the causal effect of large banks on household credit access might differ from the baseline Ols estimates presented in Table 2. In particular, an omitted variables problem could contribute to the relationship if large bank market share is negatively correlated with a component of low-income borrowers' credit quality that is not captured by credit scores or the other control variables. It is useful to think of large bank market share primarily as a function of where large banks choose to locate branches because as recently as the early 1970s, the vast majority of banks were small. The differences in large bank market share that have developed across geographic areas since then are the result of both regulatory barriers to bank expansion, discussed in Section 1, and large banks' decisions of where to acquire the local small banks and/or build branches. Therefore, it is important to discuss how we might expect the Ols results to be affected by the fact that large banks choose where to locate their branches. The expected sign of the correlation between large bank market share and the unobservable component of borrower credit quality depends on how large banks choose where to put their branches. If large banks put branches where they intend to lend to households, potentially based on household characteristics that are difficult to control for, then we should expect large bank market share to be positively correlated with the unobserved component of borrower credit quality. This positive correlation would bias the Ols estimate of the effect of large bank market share on credit approval upwards, which would work against the baseline Ols finding that large banks reduce household credit access. Despite the borrower, census tract, and county-level controls, one aspect of borrower credit quality that might be difficult to control for is the expected future economic conditions where the person lives. We might expect large banks to put branches in areas where they expect the local economy to improve. If on average the economic growth in these areas improves the ability of low-income borrowers to repay loans in the future, that is, improves their credit quality today, we should expect a positive correlation between large bank market share and the unobserved component of borrower credit quality. This correlation would also bias the Ols results against finding that large bank market share reduces household credit access. On the other hand, large banks may decide where to locate their branches primarily based on the expected profits from lending to local businesses, or based on where they expect to receive inexpensive financing through deposits from wealthy households. If the profitability of lending to local businesses and/or attracting wealthy households as customers is negatively correlated with an unobserved component of low-income borrowers' credit quality, then the resulting omitted variables bias could contribute to the relationship found in the baseline Ols results. Although it does not seem particularly likely that the profitability of lending to businesses, or the deposits from wealthy households, are negatively correlated with the profitability of lending to households of low economic status, it may be more plausible in some areas than others. For instance, in urban areas and places with high levels of income inequality, the fates of businesses and households of high economic status may be less closely tied to the fates of households of low economic status. Therefore, I split the sample based on these dimensions and repeat the regressions from Table 2 on the subsamples in order to examine whether the negative effect of large bank market share on credit approval is restricted to, or driven by a certain type of location. Table 3 presents the results of regressions of credit approval on large bank market share, its interaction with subprime, and the control variables. Columns 1 and 2 split the sample into urban and rural areas based on whether the person lives in a metropolitan statistical area, MSA. The table also shows the results when the sample is split below the median level of income inequality, columns 3 and 4, and minority population share, columns 5 and 6. The sample split on minority population share is motivated by the literature on discrimination in lending, see for example, Munnell et al., 1996. The results show that in each of the 6 subsamples, large bank market share has a negative effect on credit approval for individuals with subprime credit scores. The effect on borrowers with prime credit scores is significantly less negative in each subsample, and the effect on these borrowers is insignificantly different from 0 or positive in several subsamples. This finding that the baseline Ols results hold in each of the subsamples shows that the effect of large bank market share on credit approval is not driven by a certain type of location, and requires alternative explanations for the results to be applicable in each subsample. 3.3. Instrumental variables approach. I use an instrumental variables approach to isolate exogenous variation in large bank market share and avoid any omitted variables bias resulting from large banks choosing where to locate their branches. The approach exploits the differences in state policies toward interstate bank branching that are described in detail in Section 1. These policies directly affect the ability of out-of-state banks, for example, national banks, to enter local markets through building new branches or purchasing existing ones. I follow Rice and Strahan 2010 and use an index that describes the number of regulatory restrictions that out-of-state banks face when they consider establishing a branch in a state. The index ranges from 0 to 4 and increases by 1 if the state restricts the ability of out-of-state banks to build de novo branches or purchase individual branches of an existing bank. The index also increases by 1 if the state requires target banks in an interstate merger to have less than a 30% share of the state's deposits, or to be at least 3 years old. Based on the index of regulatory restrictions, I identify 36 state borders where one state has strong barriers to out-of-state bank branching, 3 or 4 barriers, and the other state is open to out-of-state bank entry, 0 or 1 barrier. I find that these regulatory barriers affect large bank market share. Bank branches in the states with strong barriers are owned by smaller banks. In order to exploit this variation in large bank market share, I select everyone in the credit bureau data living within 50 miles of these borders and use their location relative to the border to instrument for large bank market share. Figure 3 presents a map of the continental United States with the census tracts in these border areas highlighted. The instrumental variable I use, position relative to border, ranges from -50 in the interior of states with strong regulatory barriers, to 50 in the interior of states that are open to out-of-state bank entry. Position relative to border has a positive effect on large bank market share because banks in the states with barriers to entry are smaller than their counterparts in the neighboring state that is open to out-of-state bank entry. The top left plot in Figure 4 shows the relationship between a census tract's position relative to border and the residual fraction of the bank branches in the tract that are owned by banks with assets greater than $1 billion 2010. These residuals are from a census tract level regression of the large bank share in the tract on tract characteristics and year fixed effects. The plot shows that conditional on census tract characteristics, large banks own a higher percentage of branches in states that are open to out-of-state bank branching. The bottom left and bottom right plots in Figure 4 show how credit approval varies across state borders for borrowers with prime and subprime credit scores respectively. These figures plot the residual credit approval from an individual level regression, against the person's position relative to border. The individual level regression includes all of the controls from the previous regressions in tables 2 and 3 except large bank market share and the state year fixed effects. The figures suggest that both prime and subprime borrowers experience greater credit access when local banks are small, but the effect appears to be larger for subprime borrowers. The ensuing instrumental variables regressions formalize this approach. Table 4 presents the first stage regressions for the instrumental variables approach. Column 1 shows the results when large bank market share is regressed on position relative to border and individual, census tract, and county-level controls, as well as state year fixed effects. Because this paper tests whether the effect of large bank market share is different for households of low economic status, I also instrument for the interaction between large bank market share and indicators of low economic status, low income, subprime, and limited credit history. Columns 2 to 4 show the first stage regressions for these interaction terms. I instrument for the interaction between the low economic status indicator and large bank market share with the indicator's interaction with position relative to border. The results show that position relative to border is a strong predictor of large bank market share even after controlling for characteristics of the local population as well as state year fixed effects. The interactions with position relative to border also predict the interactions with large bank market share in columns 2 to 4. The instrument's power comes from the fact that the regulatory barriers make it more costly for large out-of-state banks to enter local markets in one state. The identifying assumption necessary to satisfy the exclusion restriction is that, for two borrowers in the same state during the same year, controlling for credit scores and individual, census tract, and county-level characteristics, their distance to the state border affects credit approval only through its effect on large bank market share. Table 5 presents the main instrumental variables regressions and their OLS counterparts. Panel A shows the results for the primary outcome variable credit approval. In the OLS regressions in column 1 to 4, the same pattern in the coefficients of interest emerges as in the baseline OLS results. When estimated across all borrowers, large bank market share has a negative effect on credit approval, but this effect is driven almost entirely by the effect on borrowers of low economic status. This pattern is even more striking in the instrumental variables results in columns 5 to 8. For instance, the results in column 7 show that a standard deviation increase in large bank market share actually increases prime borrowers' credit approval by 0.92 percentage points compared to a mean of 80.9%. In contrast, for subprime borrowers a standard deviation increase in large bank market share reduces credit approval by 3.78 percentage points, 0.92 to 4.70, compared to their mean credit approval of 53.0%. The results in Panel A of Table 5 show that having large local banks reduces credit access for borrowers of low economic status, whereas borrowers of high economic status continue to receive credit and may even experience increased credit access. This pattern holds when borrowers of low economic status are defined as those with low incomes, low credit scores, or limited credit histories. The remaining panels of Table 5 present the OLS and instrumental variables estimates of the effect of large bank market share on several additional outcome variables. The tests in Panel B restrict the sample to individuals who had no mortgage as of the end of the prior year, and whose credit file indicates that a lender checked their credit score as part of a mortgage application during the current year. The credit bureau data does not require that the borrower complete the mortgage application process in order to classify them as having applied for a mortgage during the year. The advantage of this aspect of the data is that it will capture cases where, following a credit check, the bank either explicitly or implicitly signals to the borrower that they are unlikely to receive credit. Measuring mortgage credit. Approval with the credit bureau data counts these cases as failed attempts to open a mortgage. This method of measuring mortgage credit approval results in considerably lower approval rates than those typically computed from HMDA application data. The difference arises because researchers using the HMDA data typically only examine applications that the lender reports making a final lending decision on, which excludes applications the lender reports as being withdrawn or having incomplete information, and these applications constituted 14% of HMDA applications in 2015. Reassuringly, I find that the inferences drawn from the Credit Bureau and HMDA data agree. Large banks reduce low-income households' access to mortgage credit. The results in column 7 of Panel B show that for borrowers without an existing mortgage, a standard deviation increase in large bank market share has an insignificant effect on mortgage approval if you have a prime credit score, whereas it reduces the chances of mortgage approval by 2.56 minus 0.6191.941 percentage points for borrowers with subprime credit scores. The tests in panels C and D of Table 5 use the share of a borrower's debt that is on credit cards, and an indicator for whether they have outstanding retail debt, as the outcome variables. Borrowing on credit cards or from retailers is typically more expensive than borrowing from a bank in the form of a mortgage, home equity line of credit, personal installment loan, etc. Therefore, if borrowers face credit rationing from local banks, these sources of credit may serve as more expensive substitutes. The instrumental variables results in Panel C show that a standard deviation increase in large bank market share has an insignificant effect on the share of debt that prime borrowers hold on credit cards, whereas it increases credit card debt share for subprime borrowers by 4.05%, 0.502 plus 3.551. The results in Panel D show that borrowers of low economic status are also more likely to borrow from retailers when local banks are large. The finding that large local banks cause borrowers of low economic status to borrow using more expensive sources of debt provides further evidence that they face increased credit rationing from large banks. 4. Bank size, soft information, and lending to households. 4.1. Bank size and mortgage credit access. In this section I test the hypothesis that small banks incorporate more soft information into their lending decisions involving households than large banks do. I also examine whether soft information plays a larger role when banks evaluate low-income borrowers than when they evaluate high-income borrowers. If small banks do in fact incorporate more soft information into lending decisions, and this information is especially important when lending to low-income borrowers, it could offer an explanation for the results in Section 3 showing that low-income borrowers experience reduced credit access when local banks are large. In order to evaluate the extent to which banks utilize soft information in their lending decisions, I examine the effect of borrower-lender distance on the likelihood that credit applications are approved. I interpret the extent to which credit approval rates decrease with borrower-lender distance as a measure of how much soft information is utilized in lending decisions. This approach follows the assumption in the literature that soft information collection is the main channel through which borrower-lender distance affects credit terms. For example, Peterson and Rajan 2002, DeYoung et al. 2008, Agarwal and Hauswald 2010. I examine the role of soft information in banks lending to households using data from the Home Mortgage Disclosure Act. The HMDA data include the identity of the lender receiving the mortgage application, their decision to approve or deny the application, and information on the applicant and the loan they requested. All banks with total assets above $44 million 2016 threshold, and at least one branch in a metropolitan statistical area are required to report HMDA data. Following the process described in Section 2, I construct a sample of just over 4.7 million conventional mortgage applications received by commercial banks between 2010 and 2015. Table 6 summarizes these mortgage application data and shows that small banks receive approximately 21% of conventional mortgage applications, that the median distance from the real property to the bank's nearest branch is 3.3 miles, and that the median loan amount applied for is $171,000. Figure 5 shows the relationship between mortgage approval rates and borrower-lender distance at small versus large banks. The left plot shows the results for low-income applicants, reported incomes below the U.S. median household income. The plot shows that small banks approve a higher percentage of low-income borrowers' applications than large banks, and that the likelihood of approval increases significantly at small banks when the real property is close to one of the bank's branches. On the other hand, borrower-lender distance does not appear to affect mortgage approval much at large banks. The right plot in Figure 5 shows the results for high-income borrowers. These borrowers also have higher approval rates at small banks, but the relationship between borrower-lender distance and approval rates is less striking. To formally test the hypothesis that borrower-lender distance has a larger effect on lending decisions at small banks, I regress an indicator for the mortgage application being approved on the distance to the bank's nearest branch. Its interaction with small bank indicates the bank has less than $1 billion in assets and control variables. The controls include borrower, census tract, and bank characteristics, as well as county year fixed effects. The county year fixed effects are included to capture across-county variation in borrower creditworthiness, local housing market conditions, and state policies that affect mortgage credit availability, for example, foreclosure laws. The applicant characteristics work to control for any remaining variation in the creditworthiness of applicants within the same county year applying to small versus large banks. These characteristics include the applicant's income, the loan amount, the loan-to-income ratio, and an indicator for joint applications, multiple applicants. I also include indicators for one or more of the applicants being a minority, given the literature on mortgage discrimination, for example, Munnell et al., 1996. One disadvantage of the HMDA data is that it does not include the applicant's credit score. Unfortunately, the credit bureau data cannot be directly linked to all HMDA mortgage applications. In the next section, I match the datasets for most originated loans. However, I am able to alleviate concerns stemming from applicant credit scores being unavailable by controlling for the average credit score of residents in the census tract in which the applicant is trying to purchase a home. I also control for the ratio of the applicant's income, loan-to-income ratio, and loan amount, to the average of all applicants within the census tract that year. These variables are designed to capture whether the applicant is likely more or less creditworthy than the typical applicant in the census tract. Table 7 presents the regressions showing the effect of borrower-lender distance on mortgage approval. Column 1 shows that for the full sample of borrowers and banks, each additional mile between the borrower and the bank reduces the chances of a mortgage being approved by 0.087 percentage points. Column 2 shows that the effect of distance on mortgage approval is over twice as large at small banks compared to large banks. Column 3 shows that the effect of distance is over 3 times as large for low-income applicants compared to high-income applicants. Columns 4 and 5 split the sample based on whether the applicant has a low or high income and show that in each case borrower-lender distance matters more at small banks. The positive estimated effect of small bank of approximately 1 percentage point in these regressions also confirms the observation from Figure 5 that small banks approve a higher percentage of mortgage applications than large banks. The results in Table 7 show that small banks utilize more soft information in their lending decisions than large banks and ration credit less. The results also show that soft information is utilized more heavily when lending to low-income borrowers compared to high-income borrowers. These findings suggest that large banks' comparative disadvantage at utilizing soft information is likely a driving force behind the results in Section 3, When local banks are large, less soft information is produced about local borrowers, and these borrowers experience reduced credit access. We should expect the reduction in credit access to be largest for borrowers for whom soft information is most important, for example, low-income borrowers, just as in the results in Section 3.